Welcome back to Market Masters Deep Dive, where we explore the strategies, stories, and secrets of history's greatest traders. I'm Warren, and this is episode 1 of our comprehensive series breaking down the top 100 market masters of all time. Today, we're diving deep into market masters numbers 100 through 90. While these market gurus may not have the household name recognition of a George Soros or Warren Buffett, their contributions to trading methodology and market understanding have influenced countless professionals in the industry. Please check out our channel as we have a 2-hour and 45-minute video on the top 100 market masters. In this episode, we'll delve into the unique approaches of these traders to the markets, examine their most successful strategies, and learn from both their triumphs and setbacks. Whether you're a seasoned trader or just starting your journey, there's valuable insight to be gained from studying how these market masters built their reputations. Welcome to Warren's Money Buffet. Join our Market Masters community to unlock your financial potential. Discover innovative investment strategies and grow your wealth with us. Don't miss out. Like, subscribe, and comment to stay updated with Warren's Money Buffet. Get ready to transform your financial future. Elevate your insights on Substack. Our premium tier offers exclusive portfolio access and monthly deep dive reports. Free updates are also available. Become a founding member for personalized portfolio reviews and exclusive Q&A sessions. Gain priority access to all our new content and insights. Remember, our content is for educational purposes only. Investing involves risk, and we are not financial advisors. Always do your research. Let's begin our deep dive into number 100, Nicolas Darvas. Darvas wasn't your typical Wall Street trader. He was a professional ballroom dancer who developed his famous box theory while touring the world. Born in Hungary, Darvas escaped the communist regime and eventually made his way to the United States, where he transformed $10,000 into $2 million in just 18 months during the late 1950s. Key strategy, the Darvas box. Theory identifies stocks trading within specific price ranges, boxes, and buys when prices break out of these ranges on high volume, indicating strong momentum.
Imagine that price, was trading within these boxes. And what Darvas would do is when he had a break from a breakout, so moving from one box to the price range that he had decided, so we could be calling this, say, $10, and this could be $8. So the box could be trading in a range between $8 and $10. So what he would do is he would then buy on a breakout when price moved up to a higher box range. And then what he would do is try and decipher the range of that box as well. So what I would then be looking to do that, and I'm going to show you on a chart through my lens and how I would apply this, is I'd be going, potentially we're looking for a change of character and a shakeout type event in terms of a reaccumulation box to form, so the buying climax, change character into a shakeout, or potentially into an automatic reaction as well if it's going to have more of the bearish bias. So price would then accelerate into another box, would come down, price would accelerate into another box, come down, and then he would never buy. So his stop loss, if I start highlighting where his buys are going to be, it's obviously going to be there, it's obviously going to be there. His stop loss triggers, are going to be in these regions here as price moved back into a lower box. So he would never buy a stock when it moved into a lower box. So then obviously we're back in our box here. We break out, come down, back in a box, we break out, he'd buy there, we come through, and so on and so forth. So where he is buying is he's trying to buy as the box, so the price range increases, and he's buying on the transition from one box to another box. Now, obviously, it's quite subjective as to where do you define the ranges of the boxes, but these are the points of which Nicolas Darvas, is buying, and then his stop loss, as we said, would be as it moved back down from one box to another box. And obviously he's not buying in these regions here, he's buying the breakouts, so as the price is accelerating throughout the boxes. So basically breakout trading and using the fractal nature of the boxes. So at each of these boxes, this could then be a high of say $13 for this box. This could then be going up to say $17. So again, this is $17. This could then be $20 up here. So the boxes have different, that would be 17, that would be back down to our 13, and this would be back down to our 10. So you can see how he would start scaling up into positions. And again, this is a very good way to hold stocks for a long period of time if you're trying to, what we'd call in the Wyckoff methodology, if you're trying to campaign stocks as well and adding on reaccumulation breakouts, such as Darvas was doing. So let's now jump on to this chart here, which is going to be of Apple, and what we're going to do is work through it okay, together, and we're basically just going to go through bar by bar to see where we would have been taking trades using the Darvas box strategy. So, and put the magic pen down a sec. Let's get the magnet. So what we're going to do is we can see that the stock was obviously in an uptrend. Okay, remember that Darvas, if this is the range of our box in here, okay, remember Darvas is only buying as we're progressing up through the boxes. So what we want to do is identify a potential low that has a swift change of character, okay, a sharp rally to start identifying the outer boundaries of our box. So we can potentially see something here. We can see a move to the downside and then a sharp increase here. So what we're going to do is we'd mark the low point and the high point. That's irritating that it won't let me do it right there. Come on. Okay, something like that. So now what we can see is the outer boundaries of our box here. So what we're doing is we're looking for a break to the upside above the high of this box. In this instance, it's going to be $16.36. So we can now delete our upper box up here, okay, because we're just progressing here. We can see a break below. Okay, remember we're looking for a break to the upside, and of course you could then start to identify, okay, leave me there. Okay, you could then start to identify again the whole fractal nature of this. Okay, boxes within boxes. So then we could have a box between the blue, so $11.31 and $14.80. But again, we're trying to do this on a bit more of a macro zoomed out scale. So we're using this point here, which is $12.19 and $16.63, because remember what we're trying to do is from the Wyckoff accumulation base, we're then trying to capture the meat of the uptrend as we move from our phase 1 accumulation structure into our phase 2 markup. So this is going to be the outer boundaries here. So we keep going, we see another break below. We keep going, Remember, we've got our big box forming here, which again is going to be the phase 1. So this is going to be our Wyckoff accumulation structure, and now we're looking to go from phase 1 into phase 2. Those of you that are familiar with Mark Minervini as well, buying in phase 2 uptrends as well. Again, very similar take of the Darvas box trading strategy. Okay, buying as price breaks out of a trading range and continues its move to the upside. So what do we see here? Well, we see a bar, okay, on the 6th of April 2009 that breaks the upper boundary of our box that we've formed here. So we'd be looking to take a trade in there. So what I'm going to do is get an arrow, spin it round. Okay, so that's going to be our first entry using the Darvas box method. Okay, we've broken out from this box and we're now moving potentially into another box. So we want to see how this unfolds. So what we can see is price starting to progress upwards, coming back down, still progressing upwards though. So now what we could start to do as well is start looking for smaller boxes as we see this uptrend starting to commence. So we could draw a line there. Okay, this would form our box. I'm obviously just using lines to represent the price levels of the box. So what we can see is another box now. So $19.07 and $17.05 for the bottom of our new box that's going to form. If I do just draw the box, that might okay, so remember the box would be from this region. It would still be doing it as well. So we're just going to stick with lines. Hopefully it'll make sense. So what are we doing? We're now looking for another box to form. And what happens? We get a breakout above that box. So what do? We add to the position here. And again, this is how he scaled in to positions and accumulated these big positions in stocks. And he was able to obviously turn his $10,000 into $2 million, which was a lot of money back in the 1960s.
Number 99. Linda Bradford Raschke. stands out as one of the few women to achieve legendary status in trading, with a career spanning over 3 decades. After starting as a market maker at the Pacific Coast Stock Exchange, she later founded LBR Group, a commodity trading advisor. Key strategy: Raschke focuses on identifying specific market environments, trending versus range-bound, and applying different rule sets accordingly. She emphasizes the use of quantitative backtesting to validate strategies before deployment.
And here we'll just start looking at exactly what I'm talking about. Now, my friend Hans kept on referring to this umbrella, and I was honestly like, Hans, I have no clue what you are looking at or what you are talking about, until he explained that the umbrella trade, and I have no idea why it's called this, is where you have a candlestick tail like we have right here, and then the body of the following bar is inside that tail, and it sets up a great breakout trade where you could have a resting buy stop, and then once filled, put the protective stop on the other side of the bar. And you might get 4 great ones a week on a 5-minute S&P market. So when we look at these patterns, definitely it's up to you to investigate them and understand the frequency of occurrence. Now, here was obviously something to start getting you excited about this. I wanted to also show you, and this is why it's important for you to go back and look at these yourself, something that really did not get going here. It was a little bit more of a fizzle, but it met the classic definition of having the body inside the tail. It just ate that tail before it gave you a chance to put in a buy stop, which would have been a little bit far away. So we have our umbrella trade, and then we also have the eat the tail, okay? Now stick with me on this because I know it doesn't sound very sophisticated, but you might be surprised at some of the things that we can derive out of this. Okay, so normally with tails, they can also be called price rejection spikes. It's a failed auction where the market reached a new level and failed, okay? So no buyers came in at the top of this after that failed auction. And so we traditionally think of these tails as giving some type of indication to the opposite direction. Now, what I need to say, first of all, is that tails in light volume trading range mean nothing, that they also can be pure noise, that there isn't really a significant auction going on. But here at the tops and bottoms of swings, or right when you're first breaking, that is indeed the auction process. So let's look at this second spot right here where we had the candlestick tail. And the reason I want to go over this a couple times is because so many times it's easy to think that this was a test of this previous low, and that this tail actually means that it could be a buy, which of course is nothing further than the truth here. And we're going to look down into the dynamics of what really happens. So here there was a case where the market ate the tail, all right? Once you see something start to come back down and fill this tail area, there are very high odds that it is going to go through that tail. And sometimes people mistakenly put stops right at the bottom of those tails, which is really poor trade location. I guess some stop is better than no stop, but be mindful that if you see it start to fill, pretty high odds that it will then take that out. And if you had a sell stop there, you surely could have grabbed a few shekels to the downside. And here was a much more profound one. It was not an umbrella trade. It was just a pure eat the tail. And of course, this gave a much more dramatic move. Now, here's something about patterns and systems and strategies. What we find is that maybe 20% of the time do we truly get one of those big giant home run trades. So this is definitely an exception that you would get that type of goosing, but you never know. We never know in advance just how much or how little that market is going to give. And so it's a matter of playing the game. So when you do these types of little short-term trades, be mindful that it's the results over 20 trades that count, not just little individual ones. And what will happen too is if you made it a practice of trying this, you'll know very quickly if it's going to be a huge win or not, because the ones that don't go just sort of dribble and dribble. So if you did, for example, have a sell stop here, you could have had your protective stop on the other side. Here was a case, I wanted to point this out, where indeed we ate the tail, but what's so different about this is that you were really in a downtrend, and I'm simply going to use the slope of this moving average for a guideline as to the trend. So you wouldn't have gotten hurt, but you really would not have made anything here as well. It probably would have been frustrating to initiate a long up here and then just go nowhere. So first of all, we want to see the volume and a bit of trend starting. We also want to see, the defined tail structure. I'm going to point out one more trade that we'll go over. I have talked about this in the past, and this was not a trade that would have triggered, but I want to draw your attention to these V bottoms that come in. And what I like to do is to, if I have a close outside of that Keltner channel, and then we take out the high of that bar within 2 bars, that is a V spike reversal, and it does shift the momentum to the upside. So in theory, you could have used that logic for some data point right here, looking for the fact that it came back inside. But we always want to be mindful when you have that V. A lot of times people will look at this as perhaps the start of a bear flag where we could go back down and retest without recognizing that you did a complete shift in the momentum. So on this slide, I just wanted to really go over once this eat the tail concept. So let's advance on. And
Number 98, William Eckhardt, is best known as the co-creator of the famous turtle trading experiment, alongside Richard Dennis. With a background in mathematics, Eckhardt brought scientific rigor to trading at a time when most traders relied primarily on intuition. Key strategy: Eckhardt developed mechanical trading systems with strict risk management rules, limiting risk to no more than 2% per trade. He focused on removing human emotion from trading decisions through systematic approaches.
The general idea behind Turtle's trade entries was to enter a market just as it was beginning a potentially large move. Note here that the Turtles didn't mind which way the market broke, either up or down, because they traded both long and short. The exact timing of a trade was based upon the price of a market, for example crude oil, breaking either above or below a certain high or a certain low which occurred during a specific look-back period. The concept of a look-back period involves starting from the most recent period to the current trading period, and then considering the trading data for the market only over that period. In the Turtles' case, they focused on 2 look-back periods. System 1, or S1, which they classified as a short-term trading system, used a 20-day look-back period, and System 2, or S2, which they classified as a long-term trading system, used a 55-day look-back period. Let's look at an S1 long trade case study. Assume the candle on the far right labelled 0 is today. I've numbered each prior candle in the look-back period from 1 to 20. Let's only consider the highs in this sample as a potential trigger point for an S1 trade. The highest high observed during the look-back period is the high of candle 9. For S1 long trades, the price needs to trade above this high for a turtle to enter a trade. In practice, we add 1 tick to candle 9's high to determine our trigger price. A tick is simply the smallest possible price movement for the market being traded. So for stocks, 1 tick is 1 cent. If the price were to touch the trigger price or above during the current trading session, the turtles would initiate a long trade. These types of trades were often referred to as breakouts. Let's now look at an S1 short trade case study. Assume again that candle 0 is today. We start from the previous session and count back 20 days. This is our look-back period. The lowest low observed during the look-back period is the low of candle 9. Remember, the price needs to trade below this low for a turtle to enter a short trade. In this case, we subtract 1 tick from candle 9's low to determine our trigger price for our short trade. If the price were to touch the trigger price or below during the current trading session, the turtles would initiate a short trade. These types of trades were often referred to as breakdowns. System 2 trade entries worked much the same as System 1 trade entries, except System 2 long trades used a 55 period high plus 1 tick as the trigger, and System 2 short trades used a 55 period low minus 1 tick as the short trigger. In this case study, we can see that S1 and S2 trigger prices are not always the same. In fact, in many circumstances, the S2 trigger price may be substantially greater than the S1 trigger price for long trades, or substantially less than the S1 trigger price for short trades. Another small quirk of S1 trades involved only taking a trade if the last breakout or breakdown was unsuccessful. Another way to interpret this rule is a trade trigger would be rejected if the last trade trigger resulted in a successful trade. We'll define what an unsuccessful trade looks like a little later. Note that S2 trades did not share this quirk. This is because S2 trades were intended to act as a catch-all mechanism for any missed S1 trades. It was compulsory to take an S2 trade if an S1 trade had previously been rejected. This ensured that the turtles didn't miss any really big market moves. The turtles had equally strict rules for determining how many contracts they purchased at the start of a trade, and then how they were allowed to increase or reduce their position size during the course of a trade. The turtles used a percentage-based trade risk model. This means that they risked the same percentage amount of their total capital on each trade. We'll refer to the percent amount risked on each trade as percentage R. The turtles used a percentage R of 2%. 2% of a turtle's capital was allowed to be spaced out over a stop-loss distance that corresponded to 2 times the average true range, or ATR, of the market they were trading over the look-back period. Average true range is a commonly used technical analysis indicator that is generally used as a proxy for a market's volatility. The greater the volatility in a market over a particular period, the greater its average true range over that period. This means that markets with greater volatility naturally required a wider stop loss than markets with lesser volatility. This gave the turtles extra protection in volatile markets against getting stopped out of a trade before a big move they were anticipating occurred. It was a vitally important part of their trading system and a key factor in their success. The other point worth stressing here is that the turtles always used a stop loss to limit their risk. Dennis's strategy often resulted in strings of losses before a big win would occur to make up for all of those losses and a whole lot more. So the turtles needed a system that would limit their loss on each trade, but also one that helped keep the overall loss from a string of losing trades to a manageable amount. The compulsory use of stop losses helped them to do this because it avoided the question all traders inevitably end up asking themselves, should I hold or should I get out? Because the turtles used a fixed risk amount on every trade, it meant that they naturally ended up with smaller positions in really volatile markets and larger positions in less volatile markets. Let's look at how this works with a volatility-based position sizing algorithm for stocks. Let's assume you're assessing an S1 long trade. You have a starting trading bank of $10,000 and your percentage R is the same as the turtles, that is 2%. The price of the stock you intend to buy is $10 and the current 20-period ATR for the stock is 50 cents. We find the number of shares of stock to buy by first working out how much we can risk on the trade. This is called R dollars. To work out R dollars, we simply multiply our trading capital of $10,000 by percentage R. $10,000 times 2% is $200. So our R dollar amount is $200. And we're committing to risk no more than this amount on the trade. Now, don't forget that we may also have trading commissions. Let's assume $16 for these, and therefore we'll base our position sizing calculation on $184. The next step is to divide into this amount the stop loss distance, which is 2 times the ATR 20. If ATR 20 is 50 cents, then 2 times ATR 20 is $1. This means the number of shares we can trade is $184 divided by $1, which is 184 shares of stock. The math of the position sizing algorithm ensures that the wider the stop loss, the fewer the number of shares we can trade for a fixed risk amount. This means that the more volatile a stock is, and therefore the greater its ATR, the fewer the number of shares will be allowed to trade. And this concept gave the turtles extra protection against a really big, unexpected move that could skip past their stop loss. Let's look at a case study demonstrating the turtles' entry rules and position sizing concepts. The stock is Australian buy now and pay later leader Afterpay, ticker code APT on the ASX. We're going to rewind back to just after the COVID-19 pandemic, around April 2020. Afterpay had suffered a massive sell-off from around $40 per share to around $8 per share. But by April 9, which we are pretending is today, it had recovered to $22 a share. Let's investigate a potential S1 trade. The green line is joining together the highest high over the 20 periods on a rolling basis. Note that as prices fall after a peak, this line holds up until the previous highest high falls out of the 20 period sample. As they do, the green line trails lower to the next highest high and the next, and so on. By April 9, it's sitting at $27.10. This means the trigger price for a potential S1 long trade is 1 tick or 1 cent higher at $27.11. Before we get too excited, we have to check the status of our S1 filter. Remember, for an S1 trade to be valid, the last S1 trigger must have been unsuccessful, and this certainly appears to be the case. Looking at the last S1 trigger on February 20, the price certainly fell away sharply from there. In fact, February 20 marked the all-time high for Afterpay for quite some time to come. So, is this an example of where the Turtles trading system would have delivered a loss? To understand this, we need to check if the S1 trade prior to February 20 was successful or not. Looking at the chart, this trade occurred on February 4. Note that by February 20, this trade had not yet proven to be unsuccessful, as it was still trading above its designated ATR 20 stop loss. So it turns out we weren't allowed to take the trade on February 20, and clearly we dodged a bullet there. The rationale behind this quirky S1 trade filter that requires the last trade to be unsuccessful has never been published, but I suspect it helped the Turtles avoid a number of false breakouts, much like the one we just saw there on Afterpay. One thing is for sure though, Dennis would never have included this rule in his trading system if he wasn't 100% sure it improved his system's expectancy. Okay, back to the details of the trade on April 9, which we're pretending is today. We note that the current ATR 20 for Afterpay is $2.86. Remember, our position size and stop loss are based upon 2 times this distance from our intended entry point. This works out to be $5.72. Our intended entry point is $27.11. So this means the closest stop loss we can set is at $21.39. Now, let's figure out how many shares of Afterpay stock we can buy. Once again, let's use a hypothetical trading bank of $10,000, 2% as our percentage R, and $16 worth of commissions. Putting all of this data into our position sizing algorithm, it works out to a trade size of 32 shares of Afterpay stock. Okay, let's fast forward a few weeks. Afterpay triggered our S1 long entry, and lucky for us, it's now trading a little higher. But let's assume for 1 second we didn't see last month's trade. Let's assume that we're looking at Afterpay for the very first time, as at the last candle on the screen. It's April 29, and Afterpay is trading at $28.15 a share. Easy from here, right? We just go through our process of working out a trigger price, a stop loss level, and our final position size. Wrong. If this indeed was our first look at Afterpay, we'd be prohibited from entering an S1 trade because the last valid S1 trade, that is the one we used in our earlier case study, is not yet an unsuccessful trade. As a disciplined turtle trader, we would have to refrain from taking this opportunity and instead focus on a possible S2 trade setup somewhere down the track. Fast forward a few more weeks and it's now May 8. It turns out the S1 trade on April 29 would have been a very good one indeed. But as disappointing as this may be, turtles follow rules. And the rule now is to watch for a potential S2 long trade. This will occur if the price of Afterpay trades above the highest high over the last 55 periods. Looking at the chart, the highest high over the last 55 periods is $41.14. We need to add one tick to this price to get our trigger price of $41.15. The average true range over the last 55 periods, or ATR 55, is $2.29. We double this value to calculate our stop loss distance of $4.58. When we subtract $4.58 from our trigger price, we get a maximum stop loss distance of $36.57. Let's now plug this S2 trade data into our position sizing algorithm to calculate the number of shares of Afterpay stock we can buy. This works out to 40 shares. Note, this is considerably greater than the position size of 32 shares we calculated for our first case study back in early April. And this is because the volatility of Afterpay shares is less today than it was back then. So we're able to set a closer stop loss and therefore take a larger position size.
Mark Minervini emerged from humble beginnings to become a stock market champion, winning the U.S. Investing Championship with a remarkable 155% return in a single year. His journey began with no formal education or mentors, as he learned through trial and error while working various jobs. Key strategy. The Minervini trend template requires stocks to trade above key moving averages, 50-day, 150-day, and 200-day SMAs, with those averages trending upward. He focuses on stocks showing high relative strength compared to the market.
Let's look at Mark's power play setup. The setup has similarities to the high tight flag, popularized by William O'Neill, the man responsible for formulating the can slim trading strategy. A recent study spanning 10 years put the flag pattern in the top 10 chart patterns, with a success rate greater than 67%. Like many successful patterns, the flag pattern begins with a strong prior uptrend followed by a period of stagnation or consolidation. This forms a flag-like channel, also referred to as a volatility contraction, a period where price digests the supply built up from the prior upward move, whilst tightening and preparing itself for the next move. This, of course, is a simplistic example. Let's look at Mark's template for a more practical understanding. The first parameter is the need to have a strong underlying demand for the stock. This demand is easily identified by a strong uptrend in price, and although counterintuitive, the best moves often come after a large rise in price from significant demand. Many investors think that after such a move, prices are overbought and are due a correction, but this is often a classic example of buying high and selling even higher. Astute traders recognize the momentum and take advantage of it. The next requirement is the volatility contraction pattern, which forms after an increase in demand. The pattern can occur in any time frame and will often start with some profit taking, followed by more demand and a return to the high, and then another less pronounced pullback. We see it again here, which provides a series of higher lows, thereby creating a rising support line in the process. We can now clearly see the volatility contraction as price is squeezed under a level of resistance. Just as the price is being squeezed with less volatility, we also want to see volume drying up, which is evident as we reach the end of the pattern. The drying up of volume is a lack of supply and often precedes a pocket pivot, more commonly known as a breakout. It's where the volume and price action become a particular focus. Ideally, the next stage would look like this: a breakout through resistance at the pivot with considerable volume. A breakout without a significant increase in volume should be left alone. A previous video on volume and price action provides a more in-depth discussion on the subject. Having identified the buy point at the break, we now need to consider the stop-loss position. And although there is some subjectivity on its placement, it would likely be placed just below the pivot, perhaps here underneath the wick of the previous candle. We can now determine the risk portion of the position. If we look further out, we can get a feel for the potential. We saw the contraction of volatility through higher lows, a dry up of volume, a breakthrough of resistance with increased volume, and our defined risk. The continuation of demand saw the risk-reward ratio equate to 1 to 6 on the chart, a promising key metric for any strategy. A volatility contraction can appear in many forms. Some will be short, some longer, and some shallow in a more lateral form. The key word, regardless of our interpretation, is consolidation. We need to see a tightening of price, which effectively acts like a coiled spring, building pressure and acting as a catalyst for the next move. The theory suggests that expansion is followed by contraction and contraction followed by expansion. That's why you will often see these patterns play out in the charts. This contraction offers logical rationale to place a trade with low risk and is the foundation of almost all legendary trader strategies. The hidden component, which I discuss in other videos, is that with a high probability, low risk setup, you can use sensible leverage to really enhance returns, which is exactly how Mark was able to achieve more than a 300% return.
Larry Williams comes in at number 96. He has achieved legendary status for his technical trading expertise and for developing several popular indicators that bear his name. His career spans over 50 years, during which he's won the World Cup Championship of Futures Trading with a record 11x 300% return in a single year. Key strategy: Williams uses a combination of 3 key indicator types: trend measurement, using moving averages, overbought, oversold signals, Williams percent to R, and accumulation tracking, volume-based indicators. He also incorporates seasonal trends into his analysis.
We gave some specific stocks back then. It's interesting to do a little follow-up on these stocks to see exactly what helps us identifying stocks that are going to rally. These were the 4 we talked about in that March report that I did, calling for bottom in the marketplace. Where this was Tesla, as recall, my accumulation distribution on Tesla went from a lot of distribution to a lot of money flowing into this market. And of course, Tesla's rallied from about 220 to 350, a really nice rally in the stock. Interesting, right now, we're not down. We have not seen a lot of distribution in this market yet, telling me that the trend of this market should continue to be to the upside. When we see a lot of selling in the market, that's the time to get intrigued about taking profits, or if you're a short seller, sell short. We also talked about XLP. This is essentially a ETF of funds. So it doesn't move as much as an individual stock, but it also had a nice rally from 76 to 82. There was a lot of buying back here, and we've been in the sell area. Now we're kind of mixed, not under accumulation in the market. Expect this market to follow the overall market. NVIDIA, we talked about in the 90 area, was gone to about 130. Again, notice so we saw this accumulation coming in. This is my money flow index. It's in stockcharts.com. And we saw a lot of accumulation in NVIDIA, and it's had a big rally. And again, it's not in the distribution area as it was back here. So another stock that's positive, and we can expect buy pullbacks and look for this market to move higher. Apple had also come under accumulation, and we talked about being a buyer in Apple. It's gone from about 175 to 210. I would think this market, because it is again under accumulation, there's distribution in the market, right? We had accumulation back here, is a positive factor for this market rates. Well, okay, so let's cut to the chase. What about right here, right now, Larry? What does the future look like? Well, let's go look at the future. This is a general idea of what I'm expecting in the market. This is what I call a pattern from the path. The market pretty much following this pattern from the path, and you see a bit of a rally in here, another pullback, but overall, the trend should continue to be up at least into October. So is it a time for fear and panic? No, not based on this pattern from the path. Choppy, yes, but choppy to the upside. We can look at that on individual stocks as well. Patterns from the past to show what should be happening in stocks. And I forgot to put, I believe this is Tesla. Sorry, I should have had that up there. But we see again another of the high-flying stocks should continue rallying. Nice rally up, another buy point around the first part of July. Here's Google, pretty much the same thing. There's a pattern from the path that this stock has been on. I believe will continue to be on that pattern. So bullishness in a couple of really important stocks here is NVIDIA. There's the pattern from the past that's been responding to quite well, a little higher, pulled back and around the 1st of July again, rally back to the upside in NVIDIA. These are the patterns that these stocks have followed. I see no reason why they won't continue to follow those patterns. And here's Apple, pretty much follow the pattern from the past. Now, it's not perfect, but it shows that when there's tops and when there's bottoms in the market, and you can see what it says, sideways for a bit, but around July again, we should start to move back to the upside in the stock. So we've got a pretty good idea from the past of what we should see in the future, and that's really what traders need to know about. Finally, we'll look at old Facebook or Meta. Here's the pattern from the past, the pattern this market has been on. Whoa, nice up move into July. Then a pullback. We'll have to look at that when we get into July. But between now and then, interesting in all these stocks, these patterns they've been in, and this has been a pretty reliable pattern, they've continued to the upside in each and one of these patterns. And these are the major stocks in the stock market. I think it's another reason to stay bullish on the markets. Oh, and here we have Tesla. You can see what Tesla's doing here in a buy point, rally up, pull back, and another rally. That rally in Tesla started about the end of July and move back to the upside. Current rally should go into the middle of June, the first part of July. Again, we see a lot of positive action from individual stocks. So it's nice to have a forecast, and you might want to review this presentation. Go to the very first chart I showed you, the red line, the wave that I saw when we did a last forecast before the market bottom, that we moved to the upside. And I think that's going to be true. Now, let me be clear. Will the market follow this pattern precisely? No. Does it give us a good idea of when to rally and decline? Yes. I am not perfect in this business. Nobody is. Don't expect me or anybody to nail every single turn in the market. It's just not possible. Why? Because there's two types of questions. Hard questions like, what's the capital of California? Sacramento. How many people in California? Whoa, that's a soft question. There's so many different answers. Well, today, yesterday, tomorrow, it's going to be changed. So the market is full of soft questions. There's a lot of different answers that could come, and that's why the market's so difficult. But everybody wants red arrow, green arrow. They want a hard question, buy, sell. After you've traded the markets as long as I have, 63 years now, something like that, you realize there's no absolute hard and question, but there's some guidelines and paths we can follow, then use our natural intelligence or our skills to take advantage of those projections.
Martin Zweig was a legendary investor and market forecaster who famously predicted the 1987 stock market crash just days before it happened. After earning a PhD in finance, Zweig founded the Zweig Forecast newsletter, which became one of the most respected investment publications of its time. Key strategy. Zweig used a top-down approach to market timing based on interest rates, monetary policy, and technical indicators. His famous dictum was, "Don't fight the Fed," emphasizing the importance of aligning with monetary policy trends.
Probably the most well-known one was invented by Martin Zweig, and it's called the Zweig breath thrust. And it happens very rarely in the stock market. What Zweig was looking for was for the 10-day average of advanced declines to go from 0.4 to over 0.615 within a 2-week time period. You can see going back to 2008, this hasn't happened very often. The last time this happened was actually just a few days after the market low in 2018, and actually hasn't happened since then. To have that go from under 0.4 to over 0.6 within that short period of time is pretty difficult to do. But when it does happen, has been a pretty good signal that the market has reversed higher and that buyers are back in control of the price action.
Marty Schwartz, nicknamed Pitbull for his aggressive trading style, transformed from a failed academic analyst into one of Wall Street's most successful independent traders. After losing money for 9 consecutive years as a fundamental analyst, Schwartz switched to technical analysis and never looked back. Key strategy. Schwartz developed a simple but effective strategy based on the relationship between bond prices and stock index futures. He He would buy S&P futures when bonds moved up after market close and sell short when bonds moved down.
Schwartz refers to Newton's law in which an object in motion will stay in motion. He says a stock that is going up in direction is likely to continue going up, and each new high is therefore often the best place to enter a long position. Amateurs, on the other hand, try to call tops and bottoms counter to the ongoing trend, often leading to disappointment. A clear advocate of trend following, but Schwartz warns of overconfidence when benefiting from a seemingly never-ending trend, and says, "My biggest losses have always followed my largest profits." But Schwartz's views leave us with the question of how do we know when to enter and exit a trade? And how do we know if we are being overconfident whilst increasing the likelihood of a large loss occurring? The first rule I found is what Schwartz referred to as the red light, green light indicator. He says it is his favourite indicator to determine a trend. The theory is based on a 10-period EMA, which stands for Exponential Moving Average. The EMA tracks price over a set period, and gives more weighting to the most recent price movements, unlike the SMA, or Simple Moving Average, which gives an equal weighting to all price points. Schwartz looks for bullish opportunities to buy or go long on a position when price is above the 10-period EMA, or sell, even going short a position when price is below the 10-period EMA, indicating a bearish environment, or red light. Schwartz says, "My moving averages are the key to being on the right side of the trade." Schwartz, by his own admission, is a short-term trader, and a trade lasting as much as a week would be considered long-term. In fact, he says he is often in and out of a trade in 5 minutes, and never usually in a trade for more than a couple of hours. The methodology used by Schwartz requires markets with plenty of liquidity accompanied by considerable volatility. The footprints left by this price volatility can leave clues for high probability entries. For example, Schwartz would draw support and resistance lines like the ones shown here. These often also confirm the overall trend of the time frame in question. His philosophy is to buy strong stocks showing temporary weakness, much like a rubber band having to snap back. Sometimes the price is slack, and sometimes it is overstretched. Buying at a time when price is slack, at a support level above the 10-day EMA, and in a general upward trend, puts the odds of success in Schwartz's favour. When all his criteria were met, he would load up with huge amounts of capital, sometimes only looking for a 1 or 2 point move. Schwartz refers to his method as a high probability, low risk concept. The low risk aspect comes from using tight stop losses, which if triggered would indicate a break in support, and a lower probability of success. In such a situation, he would want to be out of the trade at the earliest opportunity, with any loss of capital limited to the stop loss. Stop losses are paramount to Schwartz's method, and he is repetitive throughout as to their importance, and says, "Being able to honour your stops is what separates the top dogs from the mongrels on Wall Street." Another tactic Schwartz uses is gap trading, and he presents an example in his book which we can see here. This example is called a continuation gap. A continuation gap is determined by the increasing trend prior to the gap occurring. It is a bullish signal, but Schwartz warns that a trade should only be considered if the price remains above the gap for 3 consecutive days. The other gaps Schwartz refers to are the breakaway gap and the exhaustion gap. The breakaway gap is considered the most bullish and occurs from a base. The exhaustion gap shows up at the end of a move and is a signal that prices are likely to reverse thereafter. Schwartz says any of these gaps can be a very good source of trading ideas. Another interesting tool Schwartz uses when making a trading decision is the historical performance of a given calendar period. He regularly refers to the Trader's Almanac, which provides data on the distribution of returns. As an example, here we can see the average performance for each month over the past 20 years. We can see September has historically given the worst average performance of -0.8%, whereas April has provided the best average return of 1.7%, and so on. Although Schwartz's trade decision is not based on this data, it does impact on his appetite for risk in a specific period. Schwartz also digs deeper by looking at returns for specific days of the year, and again these stats are included in the Trader's Almanac. It is a useful tool, and I'll try to add a link below for those interested. Another interesting concept Schwartz refers to is the magic T theory, which he said was key to his methodology. Named the T due to its shape and the equal distance on the left and right side. Created by Terence Laundrie, the theory suggests that if the market has, for example, spent 6 months underperforming, then it is likely the market will spend the next 6 months outperforming. The theory can be used against any time frame. Here we can see an example of a longer-term T theory based on the Dow Jones Index between 1910 and 1990. Using the most recent T, we can see a 16-year period of subnormal returns, followed by a near 16-year period of superior performance. It's certainly an interesting concept worth further research, and if a trader of Schwartz's caliber puts the concept at the core of his methodology, it's worth considering. He went on to say, "With the magic T there was order in the universe, a high and low tide every 12 hours. The magic T and I became as one." A clear character trait is evident through the thoughts of Schwartz. He is detached from any ego, from any need to be right, and is far more focused on not losing money than anything else. Many traders have this in reverse. They have a desire to be right at all costs. Schwartz says, "Most people think that they are playing against the market, but the market doesn't care. You're really playing against yourself. You have to stop trying to will things to happen in order to prove that you're right."
Michael Steinhardt achieved an impressive average annual return of 24.5% over 28 years at his hedge fund, Steinhardt Partners. Born in Brooklyn, Steinhardt graduated from the Wharton School and then began his career in finance. Key strategy: Steinhardt combined long-term macro views with short-term trading tactics. He focused on identifying market inefficiencies and taking concentrated positions when he had high conviction.
What was it that led you to think that you could make a lot of money on Wall Street?
What led me to think that was that in the period in which I started, which was probably 1960 in a vocational sense, and quite a bit before that as a teenager, as an investor, what became clear to me early on was, and I suspect I'm using a phrase I used to use, I'm not discovering America by saying this, that there were trends in the market and areas of popularity and unpopularity that reflected themselves in exaggerated price movements. And those exaggerated price movements became the basis for that phrase that you used, that I did and do use, about what's popular and what's not popular. And it seemed to me then, it seems to me now, that if one can find variant perceptions, not only which are variant, but in which you can, in your own efforts, create a degree of confidence that you may be right. There's no easier, and this is a strong statement, there's no easier way to make money in markets than having correct variant perceptions.
Coming in at number 92 is T. Boone Pickens, who transformed from an oil company executive to one of the most famous corporate raiders of the 1980s. After founding Mesa Petroleum, Pickens realized that acquiring undervalued oil companies was more profitable than drilling for new oil. Key strategy: Pickens identified companies trading below their asset values and used activist tactics to force management changes or outright sales. He recognized that many major oil companies were worth more broken up than as integrated entities.
Before long, he started his own company, Mesa Petroleum, with just $2,500. Pickens spent years out in the desert personally drilling for oil and buying up land, collecting valuable assets. He took Mesa public in 1964 and quickly realized what the power of stock can do. Turning from geology to corporate finance, Pickens became one of the first so-called corporate raiders. He unsuccessfully launched takeover bids for Gulf Oil, Phillips Petroleum, and Unocal, creating a playbook, though, that would be followed by many others over the next few decades. Take a small stake in a company, pressure it to sell itself, and become very rich in the process.
I would be foolish to sit here and tell you, that we lost in a deal where we made $500 million.
Despite his reputation as a stock-holding swashbuckler, Mr. Pickens was also an early advocate for shareholder rights, insisting that executives be compensated with stock.
Now, remember, the stockholder owns the company, and the management's the employee.
That line of thinking informed a new generation of shareholder activists. In 1997, at the age of 68, Pickens started his investment firm, BP Capital, one of the first energy-focused hedge funds. It was a nearly total flop at first, but a huge bet on natural gas in the year 2000 proved prescient and set off a run to a billion-dollar fortune. In July 2008, he self-funded a $100 million campaign aimed at making America energy independent.
We haven't done a thing to lower our dependency on foreign oil.
Though the Pickens plan never reached the scale he wanted, Pickens has been instrumental in creating a line of natural gas-powered vehicles and a company called Clean Energy Fuels.
Edward Thorp is a true Renaissance man, a mathematics professor who revolutionized both casino gambling and Wall Street. After developing the first successful card-counting system for blackjack, Thorp turned his mathematical genius to the financial markets. Key strategy: Thorp applied mathematical models to identify pricing inefficiencies in securities, particularly options. He focused on strategies with a statistical edge that could be repeatedly exploited.
The first is identifying and exploiting mispriced assets. Thorp will refuse to let the crowd do his thinking. He'll only make rational decisions based on these mathematical approaches. Quantitative analysis is the use of complex statistical modelling to guide investment decisions, crunching vast amounts of data to uncover inefficiencies in the market that others might have overlooked. Statistical arbitrage then exploits these inefficiencies, such as temporary price imbalances between related assets. For example, a stock and its futures contract. Arbitrage means buying the cheaper, undervalued asset and then selling the overvalued one, with the expectation that their prices will converge, allowing the trader to profit from the difference. By combining these techniques, Thorp maintains the edge that he's after, banking a near 20% return and pioneering a transition from intuitive to quantitative trading. But as the 1960s turn into the 1970s, there's a problem. High inflation and oil crisis create economic uncertainty, and that means unstable markets. Will Wall Street beat the card counter? Everyone told him that one day it would. But this time, the second strand of Thorp's mathematical strategy comes into play. Part 2 is minimising risk to stay in the game. Crazy though it may sound, Thorp isn't in this to make millions. He's in it to prove his theories and, of course, to help his friends. Together, this makes him extremely risk averse because he can't do that if he's not in the game. According to Gordon Gekko, greed is good, but greed can destroy you. If you chase a big win, the market crashes and you lose 90% of your capital, it takes 20 years to get it back to where you started. So Thorp's fund will be the first to be entirely market neutral, by using an innovative variety of hedging and trade pairing strategies to ensure profit regardless of the overall direction of the market. For example, it will simultaneously buy undervalued stocks designed for long-term profit and overvalued stocks designed for immediate shorting. He also uses Kelly criterion, a formula created by mathematician John Kelly in 1956. By taking into account the likelihood of profit from a particular trade in historical win-loss ratios, it helps calculate what percentage of your money you should allocate to risk. Now, Thorp has used this to great effect in his gambling, and now he applies it to his investments, allowing for maximum long-term growth with minimum risk. Diversification is also key. Investing in a wide range of opportunities and strategies means that no single position can significantly impact the fund. All this means is that regardless of the market, Thorp continues to make consistent returns without risk of 19.1% per year.
Richard Dennis is the legendary trader who, alongside William Eckhardt, created the famous turtle trading experiment. Starting with just $1,600 borrowed from family, Dennis reportedly turned it into $200 million over a decade. Key strategy: the turtle trading system focused on trend following with strict risk management rules. It used breakout patterns to enter trades and had clear position sizing guidelines based on volatility.
Market wizard Richard Dennis, the trend-following pioneer, discloses his mid-1980s turtle trading experiment, where his group of novice traders strictly followed his rules and over a 4-year period made $150 million. Though we disclose the rules here, it's important to point out that a successful system is more than just a set of rules. Dennis says, "I always say that you could publish my trading rules in the newspaper, and no one would follow them. The key is consistency and discipline. Almost anybody can make up a list of rules that are 80% as good as what we taught our people. What they won't do is give them the confidence to stick to those rules even when things are going bad." With these rules, confidence and discipline, embedded over just 2 weeks of training, the turtles earned an average annual compound rate of return of 80%. The turtle trading system had no room for subjective decision-making. It was considerably mechanical, promoted consistency, and eliminated any form of subjectivity. We evaluate the turtle system against the following components. The turtles traded commodities, more popularly known today as futures, but the most important criteria when considering the future contract was the liquidity of the underlying market. Due to the amount of money being placed into the market by the turtles, anything with a low trading volume would have made entering and exiting positions extremely difficult. This leads us on to position sizing. Turtle trader Curtis Faith said, "Position sizing is one of the most important but least understood components of any trading system." The turtles were taught a concept called N to represent underlying volatility of a particular market, and once N had been determined, the position size could be calculated. Therefore, although the position size was a fixed percentage, it was also volatility-based. The calculation of N is simply a 20-day moving average of the true range, commonly known today as the ATR, or average true range. The turtles used a position size calculation based on 1N equaling 1%. Therefore, if N was determined to be 2 for a particular market, then the position size would be 2% of account equity. The turtles called their position sizes units, and the formula is seen here. The maximum amount of units that could be traded on a single market was 4. The strategy also included the adjusting of account size. Therefore, if the markets were not moving as hoped, the notional account size would be adjusted to suit. For example, if the account size was originally $1 million, but the account lost $100,000, equaling a 10% loss, the turtles would base their next trading position on an account size of $800,000, or a 20% loss. So for every 10% drawdown, the turtles would trade based on a theoretical 20% drawdown. This would help protect capital should the markets continue to trend abnormally. The next component of the turtle system is the entry, and contrary to popular belief, the entry criteria for the turtle system is far from complex. It was based on the channel breakout systems taught by the notorious Richard Donkian, commonly known as the Donkian's channel breakout system. There were 2 systems to choose from, a shorter-term system based on a 20-day breakout, or a longer-term system based on a 55-day breakout. Some traders chose one system, whilst others chose a combination of both. An interesting point to make is that the turtles did not wait for the close of the day to determine if the price remained above the breakout point. They would enter the trade as soon as the price broke the time frame being measured. They would trade in either direction by buying the high or selling, going short, on the low. The turtles were told to pyramid the trades thereafter. For example, for every 0.5% change in price after breakout, the traders would add another 0.5% of their account to the position, up to a maximum 2%. The turtles were told to be very consistent with the entry rules, knowing that most of the returns come from a minority of trades. So if one trade was missed, it could have a huge impact on profits. An expression commonly used is, "There are old traders and there are bold traders, but there are no old bold traders. Traders that don't have stops go broke." The turtles had a predefined risk on every trade. This was non-negotiable. The maximum exposure to any position was 2% of total equity, or 2N, when accounting for volatility. Additionally, any pyramided positions would also have the stops raised, therefore ensuring maximum exposure always remained at 2%. Due to the size of funds traded, however, the turtles did not enter the stop-loss position with the broker. They did not want to reveal the positions to the market. Instead, the stop-loss figure, although predefined, was not entered until price reached the price set. Since the stops were based on N, i.e. adjusted for volatility, volatile markets had wider stops and less risk per contract. This reduced risk across all positions and gave improved risk management. Another old saying suggests, "You can never go broke taking a profit." But knowing that the turtles were trend followers, this would have often meant taking profits too early, which is one of the most common mistakes when using trend-following systems. Take this trend as an example. Many traders would have perhaps taken their profits here, after a spike in price, or possibly here after a pullback. The temptation for either exit is often too great. Of course, every trading system is different, and exiting at these points could make sense for the concept of your system, but for the turtles' trend-following system, this would have led to poor performance. So how did they exit a profitable position? Again, the exiting rules were not complex, but allowed for the capturing of a full trend. System 1 exit was simply a 10-day low. Therefore, if a 10-day low was experienced at any point in the trend, the position would be exited. Likewise, System 2 had a 20-day low exit. In terms of complexity, they were simple rules, but in terms of the psychology and discipline, following such rules is very difficult. At times, these 10 and 20-day rules would see large profits evaporate in a comparatively short space of time, especially if the chart looked more like this. Dennis said, "A good trend-following system will keep you in the market until there is evidence that the trend has changed." These exit rules provided the evidence, and the turtles would exit without hesitation. Before we move on to some of the results produced, this comment from Dennis summarizes his thoughts. "Trading was more teachable than I ever imagined. Even though I was the only one who thought it was teachable teachable beyond my wildest dreams." In 1989, the Wall Street Journal produced an article showing the results of 14 turtle traders taught by Dennis and Eckhardt. Here we have the range of annual results for each trader, and here the average annual returns for 4 years of trading. Notice how Stig Ostgaard achieved a staggering range of between 87% and 296% per year. The average return of all turtle traders equated to 80%, whereas the Barclays CTA Index, which reports the results of 110 advisors holding more than 4 years' experience, achieved an average of 25%. The S&P 500 returned 19.2% in comparison. Each of the turtles would keep 15% of the profits, whereas Dennis and Eckhardt would keep 85%. Clearly, the teachings from Dennis and Eckhardt provided huge performance benefits, with each of the turtles achieving considerably more than popular benchmarks. In summary, it was proven that in such a short period of time, someone with no prior experience could be turned into a professional trader. The turtles understood the concept of a simple trend-following system, and by applying good risk management, sticking to the rules with unquestionable consistency and discipline, outstanding results could be achieved.
We hope you enjoyed today's video. Ready to dive deeper? Like, subscribe, and hit that notification bell. Join the Warren's Money Buffet community today for continuous financial growth.